Welcome back to the Deep Dive. Today we're digging into the Q2 FY26 results for Thyrocare Technologies Ltd. One of India's big diagnostic chains. Our mission here is really to look past the headline numbers and figure out what they're telling us about their strategy, this high-volume, low-cost model, and if it's really sustainable.
Exactly. When you see results like these with pretty significant acceleration, you've got to ask, is this just the whole sector lifting, or is Thyrocare actually doing something different, something that's creating real value? We've gone through the earnings call, the financials, the usual stuff, and we're trying to piece together what's really driving things operationally.
Yeah, and the first look is definitely eye-catching. We're talking strong revenue growth, sure, but also margins that seem, well, almost too good for a company focused on being affordable. Plus, they're celebrating 25 years, right? And they've announced some pretty big shareholder rewards. Feels like management is signaling a lot of confidence. Okay, let's start with that top line, because that's what jumps out first. Consolidated revenue for Q2 FY26 hit 216.53 crore. What was the year-on-year growth there? And maybe more importantly, how does that stack up? Is it really standout growth?
So the consolidated growth was 22% year on year, which, 22% it's solid, absolutely. But you're right to ask about the context. The really interesting part, though, is the driver. Their core pathology business grew even faster, up 24% YoY. So it's not just everything growing equally, it's like a focused acceleration right where it matters most for them. That suggests they're getting some real operational leverage, probably in that B2B network.
Operational leverage, right? That makes sense. And it probably explains the next set of numbers, which are frankly pretty startling. Normalized EBITDA shot up 49% year on year. That's over 75 crore. But the number that really grabs you is the profit after tax, PT, up an incredible 82% YoY to nearly a 48 crore. How do you pull off that kind of profit jump in such a competitive, low-cost market?
Yeah, 82% EBT growth is huge. It really boils down to execution and discipline. Look at their margins. Gross margin is sitting at 72%. That's just huge for a volume game. And the normalized EBITDA margin is 35%. They're clearly squeezing efficiency out of every corner, testing, logistics, everything. Their whole model isn't about hiking prices. It's about massive scale and just relentless cost control driving those margins up. And critically, they're debt-free. They have over 190 crore in net cash and short-term investments. That financial strength is what makes that huge pay jump credible.
Right, and that strong financial position let the board send a pretty clear message to the market, didn't it? With that 2.1 bonus share issue. 2 new shares for everyone held.
Exactly. That 82% profit jump gives them the foundation to do it. A bonus issue doesn't cost cash, obviously, but it signals to you, the shareholder, that the underlying business is strong enough to expand the share base without hurting value. They said it's about boosting liquidity, getting more retail investors involved. Makes sense as they scale up. And they didn't stop there. They also declared an interim dividend, €7 per share, pre-bonus, so reinforcing that reward message.
Okay, so strong financials, clear rewards. Let's get under the hood a bit.
Yeah.
What's the operational engine actually look like that's driving this? They're pushing serious volume. Processed an all-time high of 53.3 million tests in Q2. That's a lot of tests.
It is. That's up 21% YoY on volume, and they served 5 million patients, which is up 12%. You can see the expansion happening through their partnerships, definitely. Their active quarterly franchise count is over 10,100 now. Compare that to about 8,446 same time last year. So, yeah, they're bringing new partners online pretty effectively, it seems.
But diagnostics isn't just about volume, right? Quality is everything. And this is where I find their strategy really interesting. They just became India's first and only 100% NABL accredited national lab chain. Apparently only like 2% of labs in India have this. Achieving it across the whole network must be incredibly expensive and complex. Is this quality push a drag on margins, or is it already baked into those high numbers we talked about?
It's definitely baked in, but think of it less as a cost and more as a strategic investment. That 100% NABL status, they see it as essential for landing those big B2B contracts. It builds trust, and they're not even stopping there. They're actually aiming for Six Sigma quality. They track complaints per million tests, CPTM, they call it. Last year it was 11.8. This quarter it's down to 3.8. And the target is under 3.4. So they're serious about minimizing errors.
So the thinking is invest heavily in quality upfront, reduce errors, reduce rework, and that ultimately lowers your long-term costs, helping those margins.
Precisely. And that focus on efficiency runs right through their logistics, too. Their average turnaround time, TAT, is just 3.52 hours once the sample hits the lab. That speed is crucial for their corporate clients, hospital partners. They're leveraging their network 37 labs in India, plus 1 in Tanzania, And they keep pushing regionally, adding new processing labs in places like Vijayawada, Bhagalpur, Roorkee, even Kashmir, trying to get processing closer to the collection points, which brings us right back to that core strategy. Affordable, high-quality testing for everyone. Growth comes from volume and efficiency, period, not price hikes. They even passed on the full GST benefit to partners. That cost discipline is just fundamental to everything they do.
Okay, let's break down the B2B side then, because that seems key. You mentioned two main pillars driving the pathology revenue growth, sort of an offline and an online channel.
Yeah, basically, the bigger chunk is the franchise business. That's your traditional model collection centers, hospitals, nursing homes. It makes up 62% of pathology revenue. And it grew a solid 20% year on year. That's the bedrock, really.
Okay, the stable base,
Yeah.
and then there's the faster growing part.
Right, the partnership business. That's the more online health tech side. Think diagnostic aggregators, employee wellness platforms. It's about 32% of pathology revenue, but it grew much faster, 35% UI. And there's a really important operational difference here, a strategic choice they made about how they handle sample collection for this segment.
Oh, how does that work?
Well, the franchisees, they handle their own collections. But for the partnership business, the online aggregators, the corporate's Thyrocare uses its own dedicated fleet of phlebotomists, almost 1,900 of them, company-owned. Why does that matter? Control. It gives them direct control over quality, over speed, over the customer experience, right at the point of collection. In that corporate space, reliability and TAT are absolutely critical. Owning that last mile is likely a huge reason they're winning those partnerships and seeing that 35% growth. It's a differentiator.
Interesting. Okay, so if they're not raising prices, but volume is up and revenue is up even faster in some segments, how are they actually increasing the revenue they get from each patient? Are they just getting people to test more?
Essentially, yes, but strategically. They're really pushing profiles and packages over individual tests, trying to increase the tests per patient, bundling value. So you see their big brands doing well. Arugium, their preventative health package, grew 19% YoY. And Jash, which focuses on lifestyle and chronic diseases, grew even faster at 31% YoY. These packages naturally have more tests, often better margins, and encourage repeat testing. So yeah, more revenue per patient encounter without touching the basic test price.
Got it. Okay, looking ahead now, management seemed quite excited about one particular area, the rise of these GLP-1 weight loss drugs. They called it a huge opportunity. Why is that such a big deal for a diagnostics company specifically?
Yeah, the GLP-1s. This is potentially massive because these drugs aren't like taking an aspirin. They require pretty intensive monitoring. You need baseline tests before starting therapy, then ongoing checks during therapy, kidney function, liver enzymes, lipids, things like that, and often follow-up tests afterwards. These aren't just simple blood sugar checks, they're more complex panels. And complex panels generally mean higher margins than the basic, high-volume stuff.
And Thyrocare is already moving on this, launching specific test packages.
They are. They've launched complementary packages specifically for GLP-1 users pre-therapy, during therapy, post-therapy. It's a clear signal they're targeting this higher value specialized testing niche. Smart move to capture that growth. And just quickly on other bits. Tanzania, while small, is growing fast, up 30% quarter on quarter. They expect revenues to double this year. And the B2G segment, business to government, they're keeping that intentionally tiny, like 1% of revenue.
Right, why stay away from government contracts? Seems like easy volume.
Margins. Management was really clear on the earnings call. The prices you get in B2G deals are usually much, much lower. It would dilute their overall profitability. Their focus is squarely on B2B and the direct-to-consumer channels, where they can leverage that 72% gross margin and efficiency. They aren't just chasing any volume. They want profitable volume.
Okay, so let's try and wrap this up. What this deep dive really shows, I think, is Thyrocare in Q2 FY26 looking like a company where aggressive B2B expansion is translating directly into really strong profitability. That 82% ADT jump, the bonus issue, it all flows from that. And this commitment to quality, the 100% in ABL, aiming for Six Sigma, it seems less like a nice to have and more like a core part of enabling that high margin partnership business, especially with their own phlebotomist fleet backing it up.
I agree. What really stands out is how it's working on two fronts. You've got this steady, solid growth from the traditional offline franchisees, and then this accelerating growth from the online tech-driven partnerships. The whole model clicks because the massive volume lets them be super efficient, which protects those high margins, which in turn allows them to keep prices affordable. And they're kind of proving that high quality and low cost can go hand in hand if you execute relentlessly.
Which brings us to a really interesting question for you, the listener, to think about going forward. Thyrocare built its identity on being the affordable choice, testing for the masses, right? High volume, low cost. But now They're actively chasing this potentially very lucrative, much more specialized GLP-1 drug testing market. That means premium panels, likely higher costs, higher prices. So the question is, how do they balance that? How does Thyrocare navigate the tension between moving into higher value, specialized testing and sticking to its core mission of being the most affordable, high-volume player? That balance between scale and specialization feels like it's going to be the big story for them over the next few years.
Yeah, that's going to be fascinating to watch, a real test of their strategic focus. Well, thanks for joining us for this deep dive.
We'll catch you on the next one.